Adding ETFs to your portfolio is a great way to juice up your returns, especially on a stock market like we're seeing today, where 1 month you can be up, 1 month you can be down. We're seeing this roller coaster type of environment. By adding these growth ETFs, it will allow you to make sure that you are getting the maximum returns, worry-free investing, so you can just sit back, relax, and just watch your portfolio be on autopilot and generate those returns. Let's jump right in. The first ETF I want to talk about is VFW, and it's one of my favorites as it's an easy way to invest passively into the S&P 500, which offers the 500 of the largest companies in the United States with just one ETF. Let's take a look. The first ticker symbol we have is VFV, which is an S&P 500 index ETF offered through Vanguard. This ETF has been around for a while. It's been around since 2012, 2013. It was trading roughly around $20 a unit when it first started. Now fast forward all the way to today, where we're looking at 2022 in September, and it's trading right around $91.54. That is a massive growth that this ETF has been seeing. And one of the reasons why I like this ETF is because it's low cost, it's passive, and with an MEA ratio of just 9 basis points. So that means it will only cost you 90 cents for every $1,000 that you have invested into this fund. It has a 12-month yield of about 1.22%, and the distributions are quarterly. And it has assets under management close to $7 billion. It's a widely popular ETF. It's one of the best ways to invest in the S&P 500 if you are in Canada. Taking a quick overview of the ETF, this is one of the best ways to invest in the S&P 500, especially if you're in Canada. You get broad US equity exposure, and you get that large capitalization exposure in stocks, because that's what the S&P 500 is. It's the 500 largest companies in the United States. And that's one of the reasons why I like this ETF. It's simple, it's easy, you get the best way to invest in the S&P 500, and it is completely a passively managed, fully replicated index strategy. It's very efficient, it's cost effective, it's one of the best ways to passively invest in the market and be hands-off with your portfolio. It's been around since November of 2012, and that means it's been around for close to 10 years, and it's showing no signs of stopping that growth. And taking a look at performance, this ETF has performed wildly well, and it's no surprise because you get the exposure of the 500 largest companies, and they are known for delivering performance. Since their inception, this ETF has returned over 330% to its investors. And if we take a look at that performance on an annualized basis, that's an over 16% return since inception. You're not going to see that kind of return from a GIC. You're not going to see that kind of return from a bond index. You're not going to see that kind of return even from some of the best dividend stocks, because this is purely focused on growth, and delivering growth it does time and time again. So let's look at an example of what that growth looks like. So if you had invested $10,000 when this fund launched back in November 30th, 2012, fast forward to today, even with the roller coaster stock market we're seeing, that portfolio would be worth close to $43,000. That's an amazing return for just buying and holding this ETF forever. So in a nutshell, it doesn't mean if a fund has done well in the past, it will continue to do so the same performance in the future. But knowing the S&P 500, knowing the US market, it will continue to grow. These companies are known for generating cash returns over and over again. But this is an ETF that I can easily hold for the next 10 years, for the next 20 years, for the next 30, 40, 50 years. This is just easy investing on autopilot. Take a look at some of the fund's characteristics. As you can see, this one ETF, in terms of the number of stocks it holds 503 stocks, which makes sense since it tracks the S&P 500. It has an average return on equity at 23.3% and an earnings growth rate at 20.1%. And that's what I mean. This is one of the best growth ETFs if you are looking to juice up your portfolio. In terms of market capitalization, 80% of the stocks, because it is the S&P 500, are large cap companies. So these are some of the largest of the large companies. In terms of its region, this should be no surprise. It is 100% based in North America, or more specifically in the United States. And you can see that right here, based in US 100%. In terms of the sector, because it's tracking the S&P 500, this will mimic the sector exposure that you get from the S&P 500. There should be no surprise. The largest sector exposure is coming from information technology, followed by healthcare at around 14%. And consumer discretionary, rounding out to top 3. As you can see, financials, communication services, industrials, it starts to sort of drop down 10, 8, and 7%, and the list goes on. Now, getting even more granular into the holding details, what are those 503 stocks that are inside this S&P 500? If you just wanted to even know, okay, what is in the S&P 500? I've heard this name a lot when you watch CNBC or this news channel, that news channel. They're always talking about the S&P 500. What is in the S&P 500? Well, there you go. These are the largest stocks that are part of the S&P 500. Apple makes up 7% of the S&P 500. Microsoft makes up 5.7% of the S&P 500. Amazon makes up 3.3% of the S&P 500, and the list goes on. Now, this list will fluctuate based on the performance of the individual stocks. That's why what I mean is that when you hold this one ETF, you get to replicate the performance on a cumulative basis on all these stocks combined. This list will change up and down, but on a whole basis, on an average basis, you will see growth. And think of it this way, this is the 500 largest companies. So if one company all of a sudden starts dropping down, it will get replaced by another company that's just growing even faster. You'll always have the 500 largest companies. This is what an ETF means when it is self-cleansing. When a stock stops performing, it will get replaced by another stock that is outperforming that one that's being replaced, because it's always going to hold the 500 largest, best performing companies. In terms of other details while looking at this ETF, such as the distribution history, this is not an ETF that you want to hold for income generation. This is a low yield ETF at 1.22%. This is a high growth ETF. It's just that the cherry on top is that you get a quarterly dividend. And the really cool part about having an ETF that's low yield but high growth, your dividends will also grow by a large amount year over year. So for example, when the fund launched back in 2012, this was a partial year, so you can't really use this one as a basis, but this was a full year in 2013. It paid a 57-cent dividend per share annually in 2013. Now fast forward all the way to today, that dividend has now grown to $1.34. That's a double of the dividends. If you owned a bunch of shares of VFV, say 100 shares in 2013, you're getting 57 cents. Now those same shares are generating $1.34. Now, well, the last piece of information that I want to talk about this ETF is that this is an S&P 500 ETF, VFV, but it trades in Canadian dollars. It trades on the TSX. But what that means is that you don't have to worry about currency conversion. You don't have to worry about your dollar being converted into US dollars or back and forth. There's no FX fees. There's no foreign conversion fees. You get to invest in the S&P 500, which is in the US, but through Canadian dollars. Let's quickly summarize why VFE makes sense for your portfolio. This is a classic investing strategy. It's been around forever. It's been timed and tested over and over again. It's been known for delivering returns. And if you were looking for an answer on how can you invest in the S&P 500, which is in the US, in Canada, well, VFV is your answer. In a nutshell, by holding this one ETF, your portfolio becomes supercharged by getting exposure to the 500 largest companies known for delivering returns. These companies just make a boatload of money, and you don't have to worry about any foreign conversion fees, no exchange gain or loss in terms of your US to Canadian dollar exposure. You just take your Canadian dollar that you get paid on a weekly, semi-monthly, or whatever, whenever you get paid, take a portion of your paycheck, put it in VFE, life is good. The next ETF I want to talk about is ZGI, also known as the BMO Global Infrastructure Index ETF. This is another ETF that I'm a big fan of if you are looking to juice up your portfolio with growth. Now this ETF, ZGI, it has been designed to replicate the performance of the Dow Jones Brookfield Infrastructure North American Listed Index. A mouthful, but it really means that you get to invest in your tracking some of the best companies that are known for building global infrastructures. So how does a company get included in this ETF? Well, it must be eligible by having a minimum float adjusted market capitalization of US $500 million, as well as a minimum 3-month daily trading volume of 1 million. That means these companies are highly liquid. These are not small companies. These are some of the larger companies that are known for building global infrastructure. Now, these companies that are in this ETF must either be in Canada or the United States, and they must make sure that 70% of their cash flows is coming from the development, ownership, lease, concession, or management of infrastructure assets. So think of this like a filter, an automatic filter, to make sure that this ETF is only picking up companies that meets the criteria of making sure it's a large company, making sure it's based in Canada or the US, and making sure at least 70% of their business is around infrastructure. because you don't want just any old companies in this ETF, because this is an ETF focused on global infrastructure. So that's another benefit of buying an ETF. It acts as an automatic filter for you. So when this list of companies changes, this filter is also making sure this list is always up to date. So this ETF is designed for investors looking for growth solutions. If you're an investor that's looking for global infrastructure exposure to equities, well, this is it right here. And it benefits from local currency appreciation. Taking a quick overview of this ETF, the fund ticker is, or the ticker symbol is, ZGI, and the assets under management around $600 million. It trades in Canadian dollars. So again, you're not worried about any foreign currency when it comes to US. It's all taken care of you because it trades in Canadian dollars. The last closing price was $45.26. It has a dividend yield of just under 3% and an MER ratio of 61 basis points. And it pays those dividends on a quarterly basis. And it's been around since 2010, so over a decade. And it's eligible for your RRSP, RRIF, RESP, DPSP, and TFSA. In terms of its risk rating, it is rated as a medium risk ETF. So why is this considered a massive growth ETF? Well, if you had invested $10,000 back in January of 2010 when this fund was launched, your $10,000 would be worth over $43,000 today. And that's a monster over 330% return in that time frame. That means on an annualized basis, this fund has delivered over 12% every year since its launch. And in terms of its dividend in 2022, so far it has paid a 33 cents per unit distribution in March, in June, and we're waiting to see what September end dividend have in store. In terms of its holdings, this one ETF has 48 different stocks within this ETF basket, and the largest stock that's part of this ETF is American Tower Corp that makes up 10% of this ETF. Enbridge, Crown Castle, they make up the top three, which make up 30% of this ETF. And these are some of the well-known names around the world: TC Energy, National Grid, Kinder Morgan. These companies are some of the more well-recognized names around the world for building global infrastructure. There will always be a need for global infrastructure, whether it's through a pipeline, whether it's through a utility, through the internet, whatever it may be. There will always be a need to further humanity's need for infrastructure. And taking a look at the sector allocation, 36% is in pipelines, 29% are based on electric, 21% is REITs. REITs could be industrial REITs like your warehouses. They could be office REITs like office towers, residential REITs like homes. In terms of its geographic allocation, 69% of the companies are US based, 22% Canada. So a quick recap of why I like this ETF and why it's one of the best ETFs for maximum growth. This ETF is designed for investors who are looking for access to the world of global infrastructure companies by just holding one basket. It's safe, it's passive, it's been around for over a decade, delivering returns around 12% annualized. The next ETF I want to talk about is VCN, or the FTSE Canada All Cap Index ETF offered by Vanguard. The current trading price for this ETF is just under $40. It has a very low MER of just 5 basis points, meaning you're going to spend 5 cents for every $1,000 you have invested into this ETF. It has a really nice yield, just under 3%, paid out quarterly, and the assets under management are just a shy of $5 billion. And this ETF has been around since early 2013, and it was trading around $25 when it initially launched. Now, fast forward to today, it's trading close to $40. And just like how we talked about earlier with VFE, where you get the 500 largest companies in the United States, this is a mirror, but for Canadian companies. That means with this one ETF, you get the largest Canadian companies for your portfolio. So if you wanted a portfolio where it was just the best US companies, the best Canadian companies, that's really it. So you can essentially only own 2 ETFs as part of your portfolio. That'll get you all the best 500 companies in the US, all the best companies in Canada. That's a full portfolio. Investing can be that easy. You can build a passively, step-backs, automated approach to investing with just 2 ETFs. Now, irrespective of other financial advisors or financial planners may tell you that you need to diversify, you need to have X number of stocks, X number of ETF. Not really. You can keep it simple. You can keep it simple as 1 ETF and still get great returns. You can keep it simple as 2, 3 ETFs and still get a well-diversified exposure around the world. Investing doesn't have to be complicated. It can be easy and it can be on autopilot. And this ETF tracks the performance of broad Canadian equity index. You get the exposure of large, mid, and small cap companies that are publicly traded in Canada. So with just one ETF, you get full Canadian exposure to the best companies in Canada. And it's a fully passively managed, fully replicated strategy focused on passive investing. It's been around since August 2013, about 9 years or so. And taking a look at its performance, this ETF on a cumulative basis has delivered close to a 100% return since it's been around. Now, obviously speaking, if you're comparing this to VFE, you're like, well, VFE delivered over a 300% return. You have to remember the fact that the economy of the United States makes up like 40% of the world's entire economy. And Canada makes up maybe around 3 to 4% of the entire world's economy. And the US is a lot more diversified. Canada is more limited in terms of its companies, but US, you have a better exposure to tech sector, better healthcare exposure. So that's why there's a difference in performance. So if you just had all Canadian companies in your portfolio, that may not make a whole lot of sense. You want that international exposure, and you can get that through VFE. So if you had invested $10,000 when this fund launched back in 2013 in August, that $10,000 would be worth just shy of $20,000. That means your money has doubled in about 9 years or so. What does that mean on an annualized basis? Where VFE has been delivering around 16%, this ETF has delivered close to 8% on an annualized basis. In terms of its portfolio characteristics, this one ETF has 185 Canadian companies with an earnings growth rate of 12.3% and a return on equity at 11.9%. And very similar to VFE, close to 80% of these companies or the companies in this ETF are large. Focus in North America, focus 100% in Canada. In terms of the sector exposure that you get from VCN, 32% comes from the financial sectors, which should be no surprise when you take a look at the companies that are in this ETF, and we'll get to that in a little bit. The energy sector makes up 18%, basic materials 11%. And if you're looking for the tech exposure in Canada, which is very limited, technology companies only make up 5% of VCN. Compare that to like 27% we saw with VFV. So taking a look at the companies that actually build up the sector exposure, this should be no surprise. The largest companies in Canada are the banks. That's why the top 2 companies in VCN, no surprise, RBC, TD, followed by your pipelines like Enbridge, CNR, Canadian Pacific Railway make up your industrial sectors, your railway exposure. Here's another bank, Bank of Nova Scotia or Scotiabank. That's 3 banks in the top 10. That's 4 banks if you count in BMO in the top 10. That's why Canada has the heaviest exposure to the financials, because the big banks just make up so much of our economy. In terms of dividends that you can expect from this ETF, it does pay on a quarterly basis. The yield is just shy of 3%. So if we take a look at the growth of those dividends, and if you're looking at VCN, you'll see eligible dividends, where VFE was known for delivering non-eligible dividends. There's a difference. VCN, if you hold in a taxable account, it is a lot more tax efficient. VFE in a taxable account is a lot less tax efficient. So if you have room, if you've maxed out your TFSA, your RSP, it might make more sense from a tax perspective to hold Canadian equities because of this the favorable tax treatment. So in 2014, the dividend per share on an annualized basis was around 54 cents. That dividend has grown to $1.03 in 2021 on an annualized basis. So it's still delivering a healthy yield around 3%, and you're still seeing that dividend grow. Let's summarize why I like this ETF so much. This is one of the easiest ways for you to invest in Canadian companies with just one holding. Growth, check. Dividends, check. Best Canadian companies that you don't have to worry about filtering in and out, check. It's passively managed. Ultra low cost. If you don't want to think about investing, you just want to put money away and just hold forever, VCN is an easy choice. Buy VCN every time you get paid. Take a portion of your paycheck, turn to VCN, turn to VFE, Canada, US, check. The next ETF I want to talk about is XUT, the iShares S&P TSX Capped Utilities Index ETF. It's currently trading around $32 per share, and it's up 5.3% even with the markets up and down and not really delivering performance this year. This sector is still showing green. So why would you want to invest in XUT? Because you get targeted exposure to Canadian utility companies, and you can focus on a sector that if the market is up, if the market is down, this sector knows how to deliver consistent, reliable returns. A lot of portfolios may be down massively this year, But if you have XUT sort of anchoring part of your portfolio, you would still see some of those greens come through. The investment objective of this ETF is super simple: long-term capital growth by following the S&P TSX Utilities Index. And take a look at this performance. We will dive in a little bit. 153% return since inception. If you had invested when this fund launched back in 2011, around $10,000 or so, that would be worth a cool $25,000 today. That is amazing growth for just holding very specific Canadian utility companies without you doing any work, since all the heavy lifting is done by this one ETF. That means on an average annualized basis, this ETF has delivered an 8.5% return since inception. And as you should expect from utilities, the dividends are very consistent. The cool thing about this ETF, it actually pays dividends on a monthly basis. So for example, in January, it paid 8.7 cents, February 8.7 cents, April 8.3 cents, and so on. It's a consistent dividend payer month over month. So if you're looking for some monthly cash flow along with growth from an ETF, this is an excellent choice. Taking a look at some of the key facts of this ETF, this has $318 million of assets under management. It's been around since 2011. This trades on the TSX. It's on the Utilities Index. It is rebalanced quarterly. It has 16 stocks in this one ETF basket. It trades for around $32 a share. Taking a look at the portfolio characteristics, it is eligible for a DRIP plan, and the yield is also very nice at 3.15%. In terms of sustainability characteristics, it's rated super high on the MSCI ESG rating with a AA rating. In terms of management fees, the MER ratio for this ETF is 60 basis points. In terms of risk, it is a medium risk ETF. Now, holdings should here be no surprise to you. This is focused on Canadian utilities, and these are some of the well-known names that make up this sector: Fortis, Brookfield Infrastructure Partners, Emera, Algonquin Power and Utilities, Hydro One, Northland Power, Brookfield Renewables. This list is some of the best utility companies in Canada, known for delivering returns, known for delivering consistent growth, known for delivering consistent dividends to shareholders. And in terms of subsector exposure breakdown, 36% of the companies in this ETF are focused on electric utilities, 30% are focused on multi-utilities, and 20% comes from renewable electricity. Let's recap why I love this ETF, because this is another easy choice for your portfolio. There will always be demand for utilities. I don't think we'll be at a point where we need less electricity, especially with electric cars coming through, everything becoming more and more electric. We will always need more power, more electricity. So you will need companies to power the future. So in other words, there is sheer demand for a sector, and the demand for this sector will continue to grow. And this sector not only does it experience good growth, it's also very less volatile. You're not going to see the graphs in this chart go like this. Steady growth that you can expect from utilities. And no matter what's happening in the economy, whether there's a recession, whether we're talking about a depression, whether we're in the good times, the bad times, we will always need power. This is a recession-proof sector. So with this one ETF, you get to diversify your portfolio for capital appreciation. You get great income along the way. It's a defensive sector that's known for generating returns time and time again, no matter what's happening in the economy. The next ETF I want to talk about is ZBK, the BMO Equal Weight US Banks Index ETF offered by BMO. So what's the portfolio strategy for this one ETF? Well, it's been designed to replicate to the extent possible the performance of the selective Equal Weight US Bank Index. And what's really neat about this ETF is that every single stock in this basket is the same proportion as they're reflected in the index. Meaning you won't see a stock that has a 10% exposure, another one that has 2% exposure. It's all equally split among every single bank stock in this one ETF. In terms of benefits for this ETF, it's designed for investors looking for growth solutions. It's designed for investors looking for US bank stocks, and it's equally weighted to lessen the risk of specific securities, and you get to benefit from US currency appreciation. Diving in further, this ETF has $760 million of assets under management, and even though you're getting exposure to US banks, you get to do it all the while trading in Canadian currency, and it's trading around $30 per share. And the distribution yield for this ETF is 2.16%, and the MER is 38 basis points, and it pays dividends on a quarterly basis. It's been around since early 2014, and it is eligible for your RRSP, RRIF, RESP, DPSP, and TFSA, and the risk rating for this ETF is high. And this is no surprise because US banks are considered a lot more riskier than your Canadian banks, which are known to be relatively safe. If you had invested $10,000 when this fund initially launched back in Feb of 2014, your $10,000 would be worth a cool $25,000 today. That's close to a 140% return. In other words, if you were to annualize that 140% return, that's a 10.6% return since inception. So this is another growth ETF. Yes, it's high risk, but it's also very high reward. This ETF is not for the faint of hearts. The distributions paid so far this year have been 17 cents. That's been paid out on March. That's been paid out in June. September, December, yet to be decided. Take a look at the holdings for this ETF. This has 23 stocks in this one basket. And because this is a US bank ETF, these names should stand out in terms of the banking sector. First Citizens Bank, M&T Bancorp, First Horizon, Regions Financial Corp, Goldman Sachs, East West Bancorp. Now, some of the names you may not recognize, and you're seeing them while they're on the top of the list, and because this is an equal weighted ETF, meaning the smaller banks have just as much say in this ETF in terms of its performance as the large banks like your Wells Fargo, like your JP Morgan, like Bank of America. That's one of the unique features of this ETF. Every single bank in this ETF gets you an equal weighted exposure. In terms of sector allocations, well, it's 100% financials and 100% based in the United States. Let's recap why I love this ETF. It's designed for investors who want exposure to the best US banks through one ETF. It's designed for growth and income, and you get to benefit from US currency appreciation. Let's face it, banks are some of the most profitable companies around the world. No matter where they are, they just generate a boatload of cash because they are embedded deeply in our lives, whether it's mortgages, whether it's mergers and acquisitions, whether it's advisory, whether it's the stock market. No matter where we are in the world, banks have a unique power over the economy. And you may as well get a piece of those profits by holding some of the best banks in the world. The last ETF I want to talk about today is a fairly new ETF having launched only in August of 2022. This ETF has been launched by TD Asset Management and is focused on the growing global carbon credit market. So it's a very unique ETF. It's not focused on equities that we just saw. It's focused on a growing commodity market. More details. So this ETF offers investors exposure to a unique and growing asset class that exhibits historically low correlation to traditional asset classes, meaning it's a great hedge for your portfolio. That way you're not just getting your exposure through all equities, you have exposure to a commodity asset class. So what is the name of this ETF? This is the TD Global Carbon Credit Index ETF, ticker symbol TCBN. Governments across the globe have adopted the practice of pricing greenhouse gas emissions to tackle climate change. With this in mind, carbon credits have emerged as an important alternative asset class by putting a price on carbon and creating a market in which the companies can trade emission permits. And that's why TD has launched this ETF to take advantage of this emerging market. This ETF provides investors with a unique opportunity to participate in the energy transition economy via carbon credits. This ETF is unique in almost every single way. One, you get to benefit by the transition from fossil fuels to more sustainable energy sources. You get positive returns from carbon credit market as well, plus the added diversification benefits in a portfolio by holding something that's not a fully reliant on the equity market. So what are some of the features of this innovative ETF? You get exposure to an attractive growing market, which is the carbon credit market, which has seen incredible growth in terms of both volumes and carbon prices, and it's expected to maintain above average long-term growth. You also get diversification and growth opportunities. Carbon credits have exhibited a historically low correlation to traditional asset classes such as the stock market or fixed income, and it's also low cost. The MER ratio for this ETF is 65 basis points, makes it one of the lowest in North America for this new asset class. Let's take a closer look at the characteristics of this ETF, the TD Global Carbon Credit Index ETF. We've already talked about the ticker symbol TCBN. It's trading right now in the low 40s. The last closing price was $40.76. It's maintained by TD Asset Management. And when we talk about diversification, this is something to pay attention to. This is a different category. It's not equities, it's alternative strategies. So we typically talk about diversification. We've talked about geographic diversification, so you're not just focused in Canada, the US, you get exposure to equities around the world. We talk about sector diversification. So, like utilities, you talk about banks, you talk about tech companies. This is another way of getting diversification because it's not just the equity market or stocks, it's a commodity asset class. And it's a new ETF. And so far, it has 1.2 assets under management and is focused on the commodity market. So, how does this investment approach work? Well, this ETF invests directly in carbon emission allowance futures and or swap agreements or a combination thereof to obtain economic exposure to carbon credits. And it will initially obtain exposure to carbon credits that trade on the European Union emission trading system. And in the future, it may provide exposure based on carbon credits that trade on other global ETFs that develop and offer even more sufficient liquidity. This is a new asset class. This is a new ETF. So as this market matures, as ETF matures, that means this will only get better in terms of even more diversification from an emerging asset class. Now, taking a look at its top 10 holdings, this is where you would typically see a bunch of companies, Apple, Microsoft, Enbridge, etc. When you take a look at your top 10 holdings, you will not see a stock because this is what I mean. It's a different asset class. It's not looking at shares of a company. You're looking at a different trading commodity. But what you need to know about this ETF, that it's a low-cost ETF that's tracking an emerging market in carbon credits. As we transition from a fossil fuel environment to more sustainable energy, this market is emerging. It's a growing market. And you can now invest in this market by sitting at home and buying this one ETF. Where traditionally, if you want exposure to these alternative asset classes, you had to be an institutional investor. Maybe you had to be a corporate investor. But now, thanks to how these ETFs have emerged, they've made investing super simple. So you get exposure to things that you could not get access to beforehand. So if you wanted to add a different type of exposure to your portfolio, such as carbon credits, TCBN is something you should look into. Thank you so much for watching. Hopefully you had some meaningful takeaways from this video. Make sure you hit that like, subscribe, and thanks button because it lets me know to produce more content like this so I can bring you even more ETFs that offer more growth solutions, more income solutions to help you diversify and build your portfolio. That's it for now. I'll talk to you in the comment section.